Padamadan is the founder and fund manager at Luminance Global Fund, joining us from Singapore. Why should we be worried here?
Good morning, Angie. We should be worried because the fundamentals are very different from what the market is indicating. We are looking at rate rises in 3 to 6 months, perhaps. Even if it is delayed by a couple of quarters, we are looking at a long, drawn-out, low-rate period ending. We are seeing China is going through a bubble. We are seeing that the liquidity-driven rally is probably taking things way out of skew. So, in this background, I would be very wary of the current market levels.
Okay, that may be the case if you're talking about a sophisticated market, but many say that on Shanghai Composite, there are a lot of retail investors that are plowing in with money, and there's just more room for upside here.
True. Money is coming in, and a lot of the money is being fueled with leverage. So we have margin trading with the brokerages in China lending money against the new money coming into the market. So it's actually kind of feeding on itself. And this kind of a liquidity-driven rally is very different from a fundamentally driven rally. So whenever the fundamentals are not so great, I would be quite wary. China has too much leverage. There's a lot of debt at the municipal bond level, and until that is sorted out, it will probably take a couple of years to sort out. Currently, the rates are being cut to help the leverage situation, but it is actually fueling more liquidity into the markets. So it is true that more money is going to the market, but that is not a fundamentally driven situation, so I would be wary of that.
So do you think then this rally that we saw in Hong Kong stocks on Friday on word that Shenzhen direct to Hong Kong is going to open up this year, that is also not based on fundamentals?
It is good that the markets are opening up. It gives more access. But the Shenzhen market is even more overvalued than Shanghai, and it's got a lot more small cap and mid cap names. There are companies at 200 times earnings, 100 times earnings. So it's not something, for example, I'm waiting to buy. In effect, I'm kind of currently underweight China and Hong Kong. I've kind of booked profits into the recent rally. So what we are seeing here is that more access is generally good. But in this case, I don't want really expensive stocks, so it doesn't add anything to me at this point. And even in the Shanghai connection, there are many days when there is not a single stock shorted because it's just very hard to short in China right now.
Okay, well, you are underweight in China. Where are you overweight?
I'm overweight Brazil. I think Brazil is going through a period of economic adjustment over the next 12 to 18 months. Actually, the second time the leftist government got into power, they're actually doing a lot of reforms. So they have a new finance minister, Mr. Levy, who came in earlier this year. He's undoing whatever happened in Ms. Rousseff's earlier term. So he's raising taxes, cutting government spending. He will probably fix the house in the next year or so. The currency has also been very weak, so in general I find Brazil quite attractive on valuation terms. This is with some stock picking in place, not buying the general ETF, but hand-picking some stocks. And I have about 25% of my fund in Brazil, expecting a good performance over the next year to 2 years.
You were also doing some hand-picking in your recent trip to the U.S. You spent 3 weeks there, knocked on doors, and what did you find? Was it generally good, or concerns there too in terms of weakness?
Generally very good. Generally very good. It's a very dynamic economy. The economy there adapts. The management is very on the ball. We are seeing they're quite aware of the macro situation. They understand that interest rates could go up. So they're taking action, and they're also competing in the marketplace. They're all having a global view, so they know they're competing in the global marketplace. So they're building world-beating products, not just trying to dominate a small niche in one part of the U.S. So I found a very agile and dynamic economy. And U.S. is the single largest market in the world, and it will continue to be so for the next several decades because the most dynamic companies are there. I found good health, and I'm handpicking some situations where they're not so affected by macro. It's either an event-driven situation or they're in a niche industry where things would probably get a lot better in the future. For example, municipal bond insurance. I'm long a company called MBIA. They're at a turning point, and I think these are good points to pick stocks where the stocks are really cheap, like half price to book and things like that. So that's how I'm looking at it.
Okay, well, Roshan, quickly before I let you go, you did 24% growth in your fund in April. In May, where are you on track to grow?
Oh, it's early days, but May it's in the positive territory, a few percentage points. The important thing is the process, and keep following the process, and things should work out over time.
Okay, Roshan Padamadan, Luminance Global Fund founder and fund manager, joining us from Singapore. Thanks so much for that, Roshan.